Hey everyone, welcome back to Money Tailors channel. Today we're diving into a timeless classic in the world of investing, The Little Book of Common Sense Investing by John C. Bogle. If you're serious about building wealth or achieving financial freedom, this is one book you can't miss. It cuts right through the noise and gives us some rock-solid advice. Let's break it down, look at the key concepts, and pull out a few lessons that can get you closer to financial independence. And of course, if you're new here, make sure to subscribe. Hit that like button if you find this video helpful, and let's jump right in. So, let's have a quick summary of the book. John Bogle, if you haven't heard of him, was a legend in the investment world. He founded Vanguard, one of the largest asset management companies globally, and changed the game with his invention of the index fund, The Little Book of Common Sense. Investing is really about one main idea. Investing doesn't have to be complicated. Bogle believed that simple passive investing, like putting your money in low-cost index funds, was the best way for average investors to get a fair slice of the stock market's returns. This approach is based on decades of data and Bogle's lifetime of experience. Let's dive into the core concepts of this book and see what makes it a classic. First big idea, index investing beats active investing. Now, what's the difference? In simple terms, active investing is like stock picking or having a manager who tries to beat the market. They're buying and selling stocks, making guesses, and taking risks to earn higher returns. But according to Bogle and tons of financial data, active investing underperforms in the long run because of high fees and market unpredictability. Over 80% of actively managed funds underperform the market over 10 years. Next big concept, costs matter. Every dollar you spend on management fees, trading fees, or any kind of fund expense is money that's no longer growing for you. Bogle calls this the tyranny of compounding costs. Just imagine, if you're paying a 1% management fee annually, it could cost you hundreds of thousands of dollars over a lifetime. That's why Bogle's all about low-cost index funds. The book also dives into market efficiency, meaning the market is so vast and information spreads so quickly that individual investors are unlikely to consistently find undervalued stocks. Essentially, the price of a stock usually reflects all known information about it. That's why Bogle recommends not trying to outsmart the market. Instead, let it work in your favor with a steady, hands-off strategy. Alright, so how does this translate into steps for financial freedom? Let's break down some key lessons Bogle teaches us in the Little Book of Common Sense Investing. Lesson 1, keep it simple. Invest in low-cost index funds. Lesson number 1, keep it simple. Bogle's top recommendation? Put your money in low-cost index funds like an S&P 500 index fund. These funds cover a broad range of companies, so you're not putting all your eggs in one basket. The costs are low, and historically the returns have been strong. It's a simple, almost set-it-and-forget-it strategy, and it works. Lesson 2 is a biggie. Avoid the hype. Every day, we're hit with stock tips, market predictions, and news headlines designed to stir emotions. But remember, Bogle believed in the long game. If you're constantly buying and selling based on short-term news, you're not just adding stress, you're adding costs. Instead, Bogle suggests sticking to a steady, diversified strategy and riding out the ups and downs. So, it's important to avoid the hype and stick to your long-term plan. Lesson 3 is all about the magic of compounding. Investing steadily over time can lead to exponential growth. Even if you start small, letting your investments compound over years or even decades can create serious wealth. This is one of the easiest ways to make your money work for you while you focus on other things in life. Therefore, don't underestimate compound growth. Another powerful lesson, minimize fees. As Bogle says, every dollar you pay in fees is a dollar lost in potential growth. By focusing on low-fee options like index funds, you're setting yourself up to keep more of your returns. And remember, those seemingly tiny percentages in fees can add up big over time. In short, minimize fees to maximize returns. Finally, Lesson 5, trust the market over time. Bogle's philosophy is about patience. He believed that despite the ups and downs, the stock market has historically gone up in the long run. Having patience and trusting this long-term trend is essential if you want to build lasting wealth. Difficult, but is critical to trust the market over time because patience pays off. All right, let's recap with a few practical takeaways. Invest in index funds. It's low cost, low stress, and has outperformed active management in the long run. Focus on the long term. Ignore the noise and stay committed to your strategy. Minimize fees. Keep as much of your money growing as possible by avoiding high-fee investments. Start early. Let it compound. Even small investments can grow exponentially over time. Patience and consistency. Wealth building takes time. Stick to your plan and let the market work for you. So that's a quick dive into The Little Book of Common Sense Investing by John C. Bogle. It's straightforward, but honestly, these simple principles can make a world of difference in your financial journey. If you're looking for financial freedom, there's a lot to learn here. Let me know in the comments, are you already investing? And if so, are you team index fund or do you like picking individual stocks? I'd love to hear from you. If you found this video helpful, please hit that like button and don't forget to subscribe for more content like this. Thanks for watching, and I'll see you in the next one.